attendance form later on. If they not giving attendance, I will inform student service to tick for you both. Yeah,
Uh,
yeah. So,
sir, sorry, sir. But I saw in your chat box the FTMS. Oh, okay, sir.
yes, you need to check. Yes, yep. It's already copied for you. Okay, let me continue with the chapter 5 because I need to finish this lecture first. Yeah. Okay. So we're talking about financing decision. That means yeah. Usually for the company there are two options. Yeah, whether by debt or loan, or the last one within by equity or shares. Okay. All right. Either one or not none of this. Yeah. So therefore, yeah, the company need to decide whether are they going for the loan or are they going for the shares. Yeah, it's simple as that because yeah, in the balance sheet, yeah, if you saw balance sheet many times, right? Yeah, balance sheet. There are asset, liability, and equity. So the question is, was your asset was financed by liability or was your asset is more financed by equity? Yeah, because those liability are and an equity is more on external money. Okay, external money. And then the money used yeah get from liability and equity it used to purchase asset. So that is how usually yeah the company works. Yeah, but in this chapter we want to see whether are they are going for more financing or are they going without financing, just going as usual. So, in this chapter, we will examine the company's choice of proper financing instrument. So, there are two-step process of selecting proper financing instrument. The first one, decide how much external capital. You see here, this one, external capital. How much extra shares that they need to sell to the investor. Yeah. And select the market and the terms of which company can raise capital. This is, we call it as the selling extra shares to investor. Okay, that is mistake. And then select or design the instrument to be sold because in an improper choice will result in excessive cost, undue risk, and inability to sell securities. Okay, what happen if we're talking about bad decision in financing? Okay, remember, yeah, whether you are doing go for equity or debt, there must be some cost. Yeah, that means, yeah, they need to make sure that the return from those financing will matching with the cost. Yeah, I mean, it is more than if more than that will be good. Undue risk. Yeah, we don't want sort of like company will facing in the future bankruptcy or solvency. Okay, or inability to sell securities. They have a securities, but none of the investor will come and interested to buy to the company shares. That is a problem. Yeah, excessive shares. Yeah, that means the share is available, but no one wants to buy it. Yeah, so that is a problem. Okay, two areas covered in this chapter, which is leverage and earnings. This one will be done by calculation part. And Higgins five-factor model is more on theory part. Okay, what is financial leverage? Yeah, financial leverage is a fundamental financial variable affecting return on equity and sustainable growth. We already learned this during chapter 3, which is sustainable growth versus actual growth. Okay, so they need to make sure that the financing that coming to the company will make sure that the company will grow. Yeah, let's say I give an example. If ABC company ABC company wants to borrow, let's say borrow 5 million. Okay, borrow 5 million. Okay, they need to ensure the money of 5 million borrowed by ABC company will be utilized fully, and then and then they will come up with the projects, and then they will ensure that the revenue can cover 5 million ringgit for the repayment back of the loan, okay, which is sales and revenue or return on investment. So those income come to ABC company will able to cover the borrowing fund of 5 million, and thus will make company become growing and growing. Okay, some of you might saying might asking, what does company growth in terms of what? Yeah, the first one, growth in terms of asset. That means asset will be increased, and then the second one, the profit will be increased as well, and then the liabilities will be reduced, and then equity will be increased as well. So we're talking about growth. Okay, we're talking about growth. That means asset increasing, profit increasing, equity increasing, liability decreasing. Because one of the main objective is to make sure that company doesn't have to get so many borrowings or debts, because it will lead to bankruptcy. It is involved substitution of fixed cost debt financing, for variable cost equity. That means, we're talking about liability and equity. I give you a numerical example. Let's say the portion of liability is 70%. That means company borrows 70% of their total money for purchasing asset. For equity, only 30%. Okay, so the substitution of fixed cost debt financing for variable cost equity means that they're switching against each other. Okay, that means they're reducing liabilities, let's say by 20%, they go for equity by 80%. Because healthy financial means that more equity rather than liability. Unhealthy financing means that more liability rather than equity. So you need to understand that company doesn't want to have so many liabilities because it will create bankruptcy. Okay, equity have less commitment, so that's why they if there is more investor come to the company, yes, that might be a good sign. So the objective here is to increase expected return and risk to owner shareholder by increasing ROE, return on equity, and earnings per share. You see the word equity and share, right? So both of them are reflecting what? Equity. Okay, so debt reduce, equity increase. We're talking about debt ratio. Debt ratio, if you learn financial management, debt ratio decrease, return on equity will be increase. Debt ratio decrease, ROE will be increase. So that is a good financing decision it will be. Okay, steps in calculating, analyzing financial leverage. So usually they will calculate these three first: TIE, TBC, and EPS. So the three main component in analyzing financial leverage with debt financing are TIE, TBC, and EPS. TIE means time interest earned. Okay, this one is more on debt. Okay, why? Debt or liability. Why? Because they have an element of interest. Remember, if company borrows money from financial institution, they need to pay in interest. Okay, the second one, times burdens covered. How many times EBIT can cover interest and sinking fund payment? Okay, so that is we're talking about TBC. This one is debt, still debt again, because interest matters. And the last one, EPS, which is earnings per share. This one is more on equity. How much earnings received from 1 unit per share? Okay, for those who still doesn't know about the word EBIT, okay, EBIT means that, okay, earnings,
Earning before income tax.
interest and tax. Bukan, not income tax, interest and tax. Okay, in other name, we call it as a operating profit. Okay, operating profit. That is other name for EBIT. Okay, so if you learn in the income statement, you know where the EBIT positions. Okay, so the second one is to calculate TIE, which is EBIT divided by interest, whereby EBIT, to calculate EBIT, which is this one, this formula, profit before tax plus interest due next year. Okay, so how to get profit before tax, which is this one, next year expected net income after tax but before new financing, divided by 1 minus tax rate. And then, yeah, for interest, you need to calculate this one. Yeah, interest, which is interest due next year on existing debt, yeah, plus new debt multiplied by new interest. Existing debt means that the old loan, the old loan, and this one is a new loan. Because remember, the company wants to make decision if they want to add more debts or more liabilities, they need to include this one as well. Okay, because new debt you need to multiply by new interest, and then this one, all loan also. That means in this one, all interest plus with new interest. Okay, later on in the calculation, I will show you how. Okay, and then to calculate TBC times burden cover, or that means EBIT, earnings before interest and tax, divided by interest expense plus all payment divided by 1 plus tax rate. So that is the formula of the times burden covered. Okay, and then earnings per share, net income divided by number of share outstanding. This is to calculate net income. Okay, whereby EBIT minus interest multiplied by 1 plus tax rate, because this is derived from the income statement. Yeah, EBIT minus interest become earnings before tax, and then minus 1 plus multiplied by 1 minus tax rate, you will become earning net profit. Yeah, divided by number of shares outstanding. Number of shares outstanding means that how much companies have their shares. Okay, and then repeat the whole process, TIE, TBC, and EPS to calculate the inclusion of selling new shares only. This is applicable for question D later on, And then the last one to cover to compare with those two. If EPS with debt financing is more than EPS in selling new shares, company will still remain to have debt financing. But if EPS with selling new shares is more than debt financing, company to choose to sell new shares. Okay, because why? EPS means that earnings per share. Of course, they want to choose the highest one. Let's say if EPS, this one is 1.2 and this one is, let's say, 0.8. This is more profitable rather than through debt financing rather than new shares. Okay, let's say this one is 2 ringgit, this one is 150. That means, selling new shares is more profitable than having a loan. So that is how it works. Okay, so these are the question. Before I'm going to the question, how to answer, I want you to read this question by yourself within 2 minutes. I will be back after 2 minutes, and then I will show you on how to do that. Please understand the structure of the question. Okay, I'll be back in 2 minutes. Sampai habis. Okay, let's have a look at the question. Okay, as the chief financial officer of Adirondack Design, you have following financial information as below. Okay, you need to understand the wordings of this information. Okay, the first one, Next year's expected net income after tax, but before new financing. Okay, but before new financing means that they don't take any loans yet or take decision to add the new shares yet. That means this is the old data. Okay, we're talking about old data. Okay, that means before they are going for additional loan or additional shares, these are the amounts expected net income after tax. Okay, the second one, sinking fund payments due next year on the existing debt. Okay, this is what happens here, whereby they need to allocate some money to pay the future loans. That means because they have existing debt and therefore they need to stand by money to repay the loan for the next year. The third one, interest due next year on the existing debt. Okay, earlier we talking about this one, repayment. Loan repayment and this one is the interest. Okay, interest is 10 million, and then common share per share price per share, this is a market price per share. This is a price that's selling at the market. The next one, common shares outstanding, this is a number of shares that company has. Okay, 20 million unit. And then this one, company tax rate 30%. Okay, so the first question is, calculate Adi Donrek times interest earn, ratio for the next year. Assuming the firm raises 50 million ringgit of new debt at an interest rate of 4%. Okay, what I'm saying here is, if they want to add more loans, okay, they have old ones. They have the old ones, but this one they want to add new. So what will happen to the TIE if they decided? Okay, let's say the old loan is 40 million. What happens to the TIE if they add another 50 million? That is a question. Try to make you understand. And then the interest rate 4% is referring to the 50 million, which is new loans. So in order to answer that question, okay, hold on a second. I open this one. Solution for the earlier question. Okay, so the first question is TIE. That means what happened to the TIE times interest earn. Okay, this one. Okay, times interest earn next year. Okay, so the original formula for times interest earn will be EBIT divided by interest. So that is the first one. Okay. The issue here is how to calculate EBIT, how to calculate interest. Okay, so EBIT, EBIT, the formula will be, okay, hold on, let me do the formula for you. Okay, which is first info, next year expected net income after tax but before new financing divided by 1 minus tax rate close bracket plus interest due. Okay, so that is the formula. All right, so where do we want to get those info? Okay, next year expected net income after tax but before new financing, please refer to this one, the first info, this one, which is 42 million ringgit. And then 1 minus tax rate, that means 1 minus, okay, tax rate. You see this one, tax rate, 30%. Okay, tax rate 30% divided by 100, yeah, which is 0.3. Yeah, okay, 0.3. And then plus interest due. Okay, interest due in this one. Interest due on next year on the existing debt. This one, 10 million ringgit. Okay, so if you press calculator, you will get, okay, 42 million. Okay, divided by 1 minus 0.3, which is 60 million, plus 10 million. You got 70 million. So this is the EBIT, yeah. Okay, so this is the EBIT, original EBIT. Yeah. Okay, so interest, yeah. Alright, so because they want to include the new loans, yeah. Okay, so the formula will be interest due plus with new debt multiply by new interest rate. Okay, so that means interest due, that means the old interest. Okay, that means this is the new one, this is the old ones. Okay, how to get interest due? This one, interest due. Earlier we talking about this one, interest due 10 million plus with new debt. Okay, how to get the new debt? Refer back to the question A. You see here, assuming the firm raises 50 million ringgit Malaysia of new debt, this one. And then this is the new interest, 4%. Yeah, so that means RM 50 million multiplied by 4%. So this is how you done it. Okay. Alright. If you press calculator, okay, I start with the 4% first. 4 divided by 100, which is equal to 0.04 multiplied by 50 million. This one. Plus with the interest due, 10 million. Which is 12 million. Okay. Done, So therefore, TIE times interest earned. I should take this one also. TIE. Alright. TIE, EBIT is already here. Interest is already here as well. So, by using the formula, just put the figures, okay, which is RM 70 million divided by RM 12 million. So, you will get the answer of, just take 2 decimal point, 5.83. Okay, so this is how you answer question A. Okay. Alright, we still have another question. Next. Okay, this is usually a longer version of the question. Okay, question B. Calculate Adidon Rex TBC ratio for next year, assuming annual sinking fund payments of the new debt will equal to 5 million ringgit. Okay, what does that mean? Okay, what does that mean? How much they need to pay extra next year, if the sinking fund of new debt will be equal to 5 million. So that means the old one is 15 million, the new one is 5 million. So they need to see how much times burden cover they need to be calculated. Alright, times burden, which is TBC. This is quite a long formula, so I'll do it for, give me some time to do a formula. Okay, which is EBIT, divided by interest expense, okay, plus with, okay, bracket, fraction, this one. All payments divided by 1 minus tax. Okay. So this is the formula. Okay. We should put the figures here. Okay, where to get EBIT? Alright, that EBIT, yeah, you can take from here also. Yeah, EBIT is already calculated up there. Yeah, EBIT, yeah, which is 70 million. Okay, divided by interest expense. Interest expense you can take from this one. Interest and interest expense is the same one, which is 12 million. Yeah. Except that this is the new one. Yeah. All payments divided by 1 plus tax rate. Okay, all payments here, you need to include this one. Sinking fund payment, 50 million, 15 million, plus the new one, 5 million. You see here, this one. This one. All payments, yeah, that means sinking payment, yeah, 15 million, plus the new payment, the new sinking payment of 5 million. So you need to add up those two, eh? Okay. All right, so 15 million. I just put RM to make it easy, yeah. 15 million plus the new one, 5 million, divided by 1 minus tax rate. Earlier we talking about tax rate 30%. Yeah, 0.3. This one. Okay. All right, done. Okay, so therefore, yeah, solve this bottom first, yeah, which is okay. 70 million doesn't have any effect yet, so 70 million. Okay, how about down there? Okay, down there you need to solve this one first, eh? Okay, 15 million plus with 5 million, which is 20 million, divided by 1 minus 0.3. Okay, and then you need to plus by 12 million. This one, yeah, 40571. 428. Okay. You can take decimal points also can. 429. Right. So you will get the answer of 70 million divided by 40751,429, which is 1.72 times. Okay. Okay, that is we call it as the earnings that can cover interest by 1.72 times. Okay, that is question B. All right, let's have a look at question C. Okay, so question C says that calculate new earning next year earning per share EPS assuming Adidon Reg raises the RM 50 million of new debt. Earlier that we talking about this one. Yeah. All right. So EPS. Okay, so the formula will be okay. EBIT minus interest and then multiply by 1 minus tax rate divided by number of shares outstanding. All right, so let's put the figures there. EBIT minus interest. Okay, EBIT we're talking about this one. You talk this one, yeah. You got this EBIT 70 million. Minus interest. Interest you have it earlier. This one, interest. Yeah, 12 million. Okay, I forgot to put the bracket. And then minus 1 minus tax. Sorry, multiply. Multiply by 1 minus 0.3, which is tax rate. This one. Yeah, tax rate. Divided by number of shares outstanding. Please have a look at this one. Common shares outstanding, 20 million unit. Okay, therefore, yeah, if you press calculator, you will get 70 million, yeah, minus 12 million, and then multiply by 1 minus 0.3, and then divided by 20 million unit, and then you will get 2.03. Okay, so that is your EPS. Yeah, that means one share have a profit of 2.03. Okay, so that is the first one. All right, I stop here first, yeah, before we proceed with question D. Okay, all right, but before that, okay, please snap this picture first. If snap picture or screenshot, because after this I will proceed with question D. Yeah. Okay, this is the first part, half part. There will be another part. Okay, snap this picture or screenshot, yeah, and then for 30 seconds, and then after that I will proceed with question D and E. Yeah. Okay, once you are done, okay, let's move on to question D. Yeah. Okay, the question D is quite tricky, because, yeah, okay, why? Okay, let's have a look at question D. Calculate, this one is the second half, that means second part. Calculate next year TIE, TBC, and EPS. That means they ask back again question A, question B, and question C, which is TIE, TBC, EPS. But this is another option. That means if Adi Donrek sells 2 million unit of new shares. Earlier we're talking about the loan of 50 million. But this is a second option, which is 2 million shares. That means they are not going for additional loan, but they are going for the new selling shares of 2 million units of new shares at the 25 ringgit a share instead of raising new debt. So you need to, what I'm saying here is you need to repeat back step A, step B, and step C, yeah, with the same formula, but do not involve anything about this one, the sinking fund and everything. Do not, yeah, because this is totally on this debt option only. Okay, so how to do that? Yeah, later on, yeah, you can see the difference between calculation D and calculation A, B, and C together. Yeah. Okay, so the first step is option 2. I just put here option 2, selling new shares of 2 million unit.
Question C, they ask raises 50,000.
Sorry, I cannot hear.
For question C, they ask raises 50 million of new debt.
Yes. Okay. Fair enough. So, okay, it's like this. This is a one group question. This is the second group. Yeah, that means for question D, you cannot mix up the information with A, B, and C related to this 50 million, because this is a different option. That means the first option. Let me summarize with you the question. What is question is all about? Okay, for question A, B, and C, this one, they are talking about option 1. Option 1, if they want to add 50 million loan. Okay, that is the first option. For question D, which is second option, which is sell shares. Sell shares of 2 million unit. So, what I'm saying here is, you cannot mix up this option 2 information with option 1 information. Yeah, because these two are different choices. Different choices, you cannot mix up together the info. Yeah, so please understand. Okay, so let me go for straight for the option 2.
Sir, the C is actually related to question number 1.
B and A, yes, B and A.
So that you will never calculate the 50,000 of new debt for C. You're
Ah,
not calculating.
yes. Okay, this one. Have you seen this one? This one. Okay,
Yes.
so all information here, like 70 million, 12 million, is all related to up here, this one. Yes, you see 70 million, this one 70 million. And then this one 12 million, this one also 12 million. So you just transfer the information down there. Yeah. Okay, let me proceed first. Okay, later on we will sort out some of the issues. Okay, first thing first, we need to calculate this one, TIE. Yeah. Okay, times interest earned. Okay, which is TIE. Okay, the formula will be hold on. Okay, there's a different formula, a little bit slightly different formula, which is EBIT divided by interest due. Okay. All right. So how to put that into the number? Okay. EBIT is similar. Okay, because you already calculated here this one EBIT. Okay, but later on you will see the differences. 70 million. Okay, interest due. Yeah, that means you just take this one only. Okay, why we didn't calculate this one? Okay, because as you can see, the earlier question is related to new debt. Okay, but the question D doesn't say anything about new debt, but it is about selling new shares. So, you don't have to put new debt multiplied by new interest rate. You cannot. You just put at the interest original only, interest due, which is 10 million. Okay, so put here 10 million. Okay, which is, the answer will be 7 million divided, 70 million, sorry. Divided by 10 million, which is 7. You see the difference between the option 2 answer, TIE, 7 times, and this one, 5.83. Okay, why this one is lower compared to this one? Because they included the new loan and new interest. That means the company need to pay more. Yeah. If the company need to pay more interest, definitely TIE will reduce. Yeah, you see here, this one, 70 million and sorry. Oh, there is no pen there. All right. So you can see here, they include this one. So that means they need to pay more, 10 million plus 2 million, which is 12 million. So that's why this one is 2 million, 12 million, which is compare with this one, 10 million. So if they increase the interest due, that means the TIE will become lower. Yeah. But if the company is reducing interest, therefore the TIE will be higher. Yeah, so that is how it works. Okay, let me finish up the calculation. Okay, the next part here is the next part is times burden covered, TBC. Okay, same formula, okay, which is same formula. I just copy here. Okay, same formula, but the figure might be different. Okay, let me show you how. Okay, EBIT is similar, yeah, which is 70 million. This one, EBIT. Okay, divided by interest expense, that means interest due, this one, interest due and interest expense. Going, bring it down there. 10 million,
Sir,
yes.
sir, 70 million means 7 billion, right?
No, 70 million.
Yeah,
Mil
70 million means 7 billion, right? Billion.
no, no,
Oh,
billion is different. Billion billion need to add 3 more zero.
three more zero.
Yes, billion. Billion is more than million.
Oh, okay.
Yes, okay, this is million. But if you want to say 70 billion, just add more 3. Yeah, this is billion, okay. All right, so all payments, okay, all payments, you need to look at the original payments only, this one. 15 million, sinking fund payment. Do not, okay, do not, because previous semester student, they tend to mix up this one. Please do not add up 5 million because 5 million, okay, is at 5 million is at question B. Yeah, which is wrong. Yeah, you cannot mix up information B to calculate question B. No, do not. Okay, so that's why 5 million is not included in the answer. 1 minus tax rate, which is 0.3. Okay, so if you press calculator, you will get, okay, I going down first, 15 million divided by 0.7 because 1 minus 0.3 and then plus 10 million. So 70 million divided by 31428, 571. So you will get the answer of 70 million divided by 31428,571, which is 2.23 times. Okay, which is differ with this one, 1.72. Why? Because you see there is an additional of 5 million, and this one is interest with the new loan, but this one is different, 10 million, and this one is not include 5 million, so that's why the amount is increasing. Yeah. All right, the last one is forgot already, earnings per share. Okay, for earnings per share, all right, the formula will be the same. Okay, EBIT minus interest, bracket, multiply by 1 minus tax rate, and then divided by number of shares outstanding. Okay, so with the formula, Okay, EBIT, yeah, earlier we talking about this one, 70 million. Minus interest, which is interest, this one, interest expense, interest due, interest due and interest expense in this case is similar, which is 10 million. Multiply by 1 minus tax rate, which is 0.3. Number of shares outstanding, yeah, you can have a look at the earlier question. Common shares outstanding here, this one. But do not forget, yeah, you have another new shares here, 2 million. So 2 million plus with, 20 million plus with 2 million. So you need to add up 20 million units.
So 20 million shares at 25. I mean, I mean 20
Oh,
million.
25 ringgit. Okay, so this one just additional information, doesn't do anything. Just ignore the information, yeah. This one we not use. Yeah, we not use. Just an additional information only. Yeah. Okay, so if you press calculator, okay, so you will get 70 million, okay, minus with 10 million, multiply by 0.7 because 1 minus 0.3, divided by 20 million plus with 2 million. So you will get 1.91. Okay, so that is how you done question B. Okay, let me finish up with question E before proceed with the question, any question. Okay, so question E say, let me finish first. Okay, based on C and D. Yeah, that means the answer of C, the answer of D. Yeah, sorry. Okay, based on the answer C and answer D, yeah, which financing decision will Adidon Rec Design choose and why? Okay, so you need to compare answer C with answer D. Okay, so EPS with new debt from question C, okay, versus EPS question D. I should bring down there. Okay, EPS with new debt, this one, this one, 2.03. And then EPS with new shares, this one, option 2, earnings per share RM, sorry, it's not times. Okay, therefore, this is more than this one. More, that means 2.03 is more than 1.91. So therefore, how to answer that? Which financing decision will Adidon Rec Design choose and why? Okay, Adidon Rec. Option 1, and this is option 1, this is option 2. Yes, by RM 2.03. So you look at the highest one. Is it by option 1 or is it by option number 2? In this case, option 1 is better than option 2. EPS with new debt is better than EPS with new shares, because it gives highest EPS by 2.03. Yeah. Okay. Please snap this picture. In the answers. Okay, you might need it. This one. Okay. Alright, so remember, the question A, B, and C is one set. Question D is another set. And question E, you need to compare the answer of C and the answer of D, Okay. All right. So we are done with chapter 5. Okay, these are the answers I already shown you. Okay. Let's move on to the last part, which is Higgins five-factor model. Okay, so this is the theory part whereby how the financing can affect EBIT, which is operating income. Okay, one of them is tax benefit due to tax deductibility of interest. There is a difference of EBIT whereby if the government can impose a tax of, let's say, 30%, and another situation is 40%. It's a different, I mean, that plays an important role in EBIT as well. The second one, distress cost imposed by various parties, when concerns arise about the company's ability to honor its financial obligation. Okay, we're talking about financial obligation. Remember, we have two, which is debt and equity. Debt is more obliged rather than equity. Why? Because no matter how company is survive or in declining, no matter how the status of the company is, they still need to pay debt, even though the company is at the whole of bankruptcy. Yeah. Okay, so that's why we're talking about financial obligation. Company is trying their best to reduce the obligation. They don't want to commit debt, and but they are more on go for equity, because equity, if let's say the business have a problem, the capital will be burned. Yeah, burn, that means you don't have to return to the investor. Investor will lose, but they don't have to pay everything. Yeah. Okay, that is the second one. The third one, financial flexibility. The possibility of high debt level will limit future financing option. Why? Because if there is debt too many, let's say 90%, and then equity only 10%, that should be a very big issue. Yeah, because they need to pay all 90% of the debt. But however, if the debt is only 10%, and the equity is only 90%. So therefore, the company is only commit 10% only. Yeah, the company is only commit 10% of their money. 90% later on, because this one is dealing with investor or shareholders. Okay, number 4, market signaling. The information managers convey when they opt one form of financing over another. This is more on the sensitivity of the news, the news, the latest update, which is influence, company's decision either to add more debt or add more equity. And the last one, management incentive, the increased pressure to generate cash flow to meet high debt service obligation. Okay, management incentive, whereby the board of director will questioning the financial manager, why is it very high debt, why we don't want to focus on equity. So that is a management incentive. If they are able to control the debt, that means reduce debt and increase equity, managers will get incentive. Okay, that's all for today. All right. Any questions so far?